Hello, everyone, and welcome to today's live stream. I was just, I was just haranguing David. Poor David. He's always getting in the neck about something. Thank you so much for coming along to join us for this session. We're certainly, I think we've restarted these live streams at exactly the right time because the markets are in a very interesting state, to say the least. Today, it's a bit of a crunch day because we've got some CPI data coming from the US. As you know, there's been a shutdown in the US, so we haven't had any data such as the non-farm payroll, etc., because of the government shutdown. I'm not quite sure how the CPI data has evaded the shutdown, but whatever the reason, that is what we are going to get. How is that reflected in the charts is also extremely interesting, and what we want to cover. We're going to cover futures, and we're also going to cover Forex as well. Who's going to do Forex and who's going to do futures, we don't know, but we're probably going to do it together. And obviously look at what VPA is telling us, also as well as the charts themselves. So I'm actually going to start with sharing my screen here. I'm not actually going to start with Forex. I'm going to start with the broader market as reflected by the MNQ. Now, the MNQ is the E-mini for the NASDAQ. And what I really want to highlight, there are a number of things I want to highlight on this chart. And one of them is to explain perhaps a little bit more about volatility and its significance, its importance, and how we have to try and deal with the unexpected volatility that we got. I call it the Trump candle, which was Friday, the 10th of October, which seemingly came out of a clear blue sky. I think in some ways we'd all become a little bit complacent. Those of you who were trading around the time of the first Trump presidency will know the impact that his constant tweeting would have on the market. But he's been quite quiet, or at least he was quite quiet until the 10th of October. And boy, oh boy, did we all suddenly wake up and discover the impact that he had. Now, how I've set this chart up, this is the daily chart. And what I have here is I've obviously got the chart and the indicators I'm using. I've got these little yellow triangles here. This is what we call our pivot indicator. The purple one is the one that is the most significant on this chart. This is what we call our volatility indicator, and it is triggered in real time. It is triggered when this candle was being formed, and it's more than an early warning system. It is telling us something serious is going on in terms of volatility. Now, just to clarify about volatility is non-directional, except in one case, and either I or David will explain that in a bit. But when we talk about volatility, it's an explosion. It's a sudden burst of energy. Momentum comes into the market, but it is non-directional. There is a definition of volatility in one of our books on binary options, and it's a definition that David came up with, and I think it's absolutely brilliant. And in fact, we've had some very nice comments about it. And this is the compression of time. And what we actually mean by that is, if you look at this candle here and the range of this candle triggered by this seemingly unexpected event. Let's just call it an event because it just happened to be Donald, but it could be something else. What do we mean by compression of time? This candle here in one day has wiped out all that price action which I think is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 9. It's about 21 sessions. So you've had that amount of price action, which is the equivalent of 21 previous sessions. That's what we mean by the compression of time. So it is a fairly dramatic price move. What happens after you have such an explosion of volatility coming into the market? Most of the time, you have what you see happening here. You have a retrace into the spread of this candle. And this candle then becomes the dominant candle on this chart, and it will dominate the price action until the high or the low of the candle is taken out, and the ultimate direction of the price action will continue. So until this is taken out with good volume, then this rally will continue, or if it's down at the bottom, we will then get the definition of the reversal. It's quite unusual to see the, let's call it a congestion, because it's congesting within the consolidation within the spread of that. It's quite unusual to see quite so many going on for quite so long. And it's testament in part to the force of the volatility. So it's like if you throw a small pebble into a pond, you get ripples. But because it's a small pebble, the ripples will, dissipate quite quickly. If you throw a huge rock into a pond, the effect of that is going to take a little bit longer for the pond to calm down. And what was interesting in the spread of the candle, you can see we had some big ranging candles. We had an up day, a down day, an up day, a down day, an up day, then an up day, and then a nothing burger day. Just nothing. Then we had a down day. And now we seem to be having a continuation of yesterday's up move. And of course, there's nothing wrong with trading within the spreads of these individual candles. This was a really tricky day, but the rest of the days it was a great trading opportunities, both to the long and the short side. And of course, we then look at the shape of the candles. Do we have wicks to the bottom of the candles? Do we have wicks to the top of the candle? Because that will then give us a clue as to what may be coming the next day. The volatility candle itself, you can see it actually ended with a wick to the bottom. So that of itself would tell us that from a price action perspective, we were going to see some kind of reversal. What's interesting, though, with this candle, if you look at the volume, this is an anomalous candle in the sense that for the size of this candle with that kind of volume, what is that going to tell you? Plus you add the wick to it, the chances are, well, more than the chances are, it is going to go within the spread of the candle, and the likelihood, the probability, it is going to go to the upside, which is exactly what it did. And we have quite a lot of volume coming in here. That's a nice up candle. You've got high volume. That's got a big wick. That's got high volume. This has got high volume, but you've got a wick to the top of the candle, so no surprise to see the price fall, but then it did recover. And then we have this one. So there is these individual candles, whilst they're within the spread of this candle, individually of themselves are telling you that what is likely to happen in the next trading session. But from an overall perspective, until we take out the high and until we take out the low, we need to confirm the direction. What does it look like at the moment? It certainly seems as though it wants to go higher. My only concern about this is the volume under this candle, because you have a really deep wick to this candle, and you have below average volume. I have an average line that I put on the volume bars, and I use a 20 period for the slower time frames, which obviously the MNQ is the daily chart. What is also really important to understand with volatility, such a candle as this, is when it appears on the slower time frames. And what that tells you, it will tell you what kind of trading condition you can expect on the faster time frames. Now, this happens to be the MNQ, but you see these in other assets as well. And I have some moving averages here. What do I think about? I'm often asked about moving averages. The moving average is not so much what I think about the moving average, it's what the market thinks about the moving average. We all have to remember we're all looking at the same charts, and this business is psychological, and trying to anticipate, well, what is everyone else out there thinking? And if the market, this is the 20, this is the 50, if prices bounced off there before, as we can see here, as we can see here, as we can see here, who am I to say that the 50 moving average is a complete waste of time? Because there's obviously a market consensus out there. There are people who trade it, and at the end of the day, if that's going to reverse the price, or the price holds at that average, I'm going to follow that belief. It's 50. It could be 45. Why not 55? Why not 60? That's what the market collectively has decided. Whether it's right or wrong, mathematically, philosophically, scientifically, is really neither here nor there, because the thing that defines this market is psychology, human psychology, and we have to be aware of that. So that is where we are at the moment. Now, the other indicator I have on here is what we call our VRSI, and that's the volume relative strength indicator, and it is volume based, and it's a really interesting indicator, especially on if you are an intraday trader and you're on the faster time frames. It works on all the time frames, but it has this median line here. And what you have with it, and I call it this, you have the flip. You have the flip where, from a volume perspective, it is telling you that even though the price might be falling, or even though the price might be rising, from a volume perspective, that move is probably coming to an end. And we then have to look at the candles. Are we going to see an anomaly? Are we going to see some kind of exhaustion in terms of a shooting star or a hammer? So it is very, very, very well. It isn't really a lagging indicator, as most other indicators are. I would say the volatility is a leading indicator, and I would also say that the VRSI is a leading indicator as well, because it tracks the volume. Now, on the faster time frames, what I've done, just to show you, is, because then we talk about levels, and those of you who come along regularly will know I don't try and clutter my charts too much. And the great thing about TradingView is you can turn things on and off. I've got the volume point of control, which I only put on just to give me an indication of when I think the congestion period is going to come to an end. We have here, I've got the Camarilla levels, because I need to know what the key support and resistance levels are. And we've also developed a multi-purpose VWAP for all our platforms, and this is just the standard VWAP, and I'd just like to know if it's congesting along the VWAP, has it pulled away from the VWAP, and of course I've got the volume, the VRSA, and this is really the sort of example I was talking about. You can see here what we have here is we have a congestion. It's following it, but you can see the volume is dying away, which is what we would expect in a congestion. And then we have the beginning of the flip, and it mirrors the volume that is coming. So it's kind of highlighting that possibly we are going to see a turn from congestion, falling volume. There's more buying volume coming in. We can see it here under this candle. This is actually a volatility candle. What happened? It reverses into the spread of the candle. And then we go back to reading our VPA. Yes, it reverses. It looks like it's going to have it's going to go to the downside. We have that, but look at the volume. We have falling volume and we have falling prices. This little candle here, yes, it is falling, but it's got a wick to the bottom. There are little wicks here and here, and it's also critically, it's on the R3 and it's also on the VWAP itself. So then we have a little bit of congestion where these bars sort of don't go anywhere, and then we have the break higher, and we have the break higher with the volume rising, which is what we want to see. So we have a really nice setup from VPA first, confirmed by the indicators. That is really, really important. The VPA validates the indicators. The indicators do not validate the VPA. This is what we're seeing. We could turn all these off, and I know there are traders out there who do. David, he doesn't use. He has it. He has a mental picture in his head. He's been doing this longer than I have. He's quite happy. Some of us, myself included, I like to just see what is going on. But some of the times I just turn them off and I turn them back on again when I just want to have. Is there a confluence? I think that's probably why I like to have them on, because if I have two key indicators telling me from a support and resistance perspective and from a volume perspective that we are looking at a significant setup, as it were, then that's all they're there for. They're there to support our initial VPA analysis. So this is the 3-minute chart. I then have the hourly chart, and the reason for the hourly chart is very simple, and it's because for the Camarilla, the levels that come up on the hourly chart are there. They're valid for a whole week. And what is interesting on this, what this tells me is it's heading for here. It gives me an idea of potential targets. It's also useful for maybe placing stops, as you would do on the levels that are on these faster time frames. All the time frames up to but not including the hour are refreshed every time the session rolls over. So it's 24 hours. On the hour, we're right up to the day. They are refreshed once a week. The third and the fourth levels are probably the most significant in terms of strength, in terms of potential reversal, and where price can congest for some time. So what we're seeing here at the moment, where is it heading to? Well, the logic is it's heading back up to 25.4 Now, this analysis, I've used the MNQ. I would have exactly the same analysis on any other asset or market. I've got some Forex here, which we'll have a look maybe later in the session. That's what I want to say on that, because I really wanted to cover volatility, especially on the slower time frames, and also how you would interpret that, what it's telling you, what is going on when you have such a huge candle. As I said, I have heard this type of candle described as the master candle, and you can look it up on the internet if you wish. And there's this idea that you will have at least 4 candles that will be within the spread of the candle. I don't think you can say that, because it really depends on the extent of the volatility and the range of the candle. But for myself, I like to use the expression the dominant candle, because it is dominating the current price list, and it will continue to dominate the current price action until we have a clear break of either the high or the low. And of course, it's even more critical because for the MNQ, as with the SPY and the QQQ, you have very similar looking candles on those two ETFs. They are touching the all-time high for each of these three charts. Right. If you've got any questions, please put them in the chat. I'm now in charge of responding, and I would like to pass you over to David, and I will stop sharing.
Thanks, Aling, and a very warm welcome to you wherever you are in the world. Morning here, but maybe a different time where you are in the world. So a very warm welcome. Just going to move that up a little bit. I'm going to start with the MNQ very quickly because I just wanted to touch on some very simple VPA lessons on the faster timeframes. So if I show my screen, which is screen 2, which is that one, there we go. Hopefully you can see that. Just check on Anna's screen. You got mine come up? Yep, fine, great. Okay. Yeah, I have. This is a very simple workspace. It's, as I say, MNQ, which is the micro contract for the NASDAQ, the NQ. So these came out, I'm going to go to the 5-minute. I've got the 15, these are very fast time frames at the top. It's got 15-second, 30-second, 1 minute. And on the bottom, we've got 2, 5, and over onto the daily. And Anna's just been through the daily with you. So let me just pop up the 5-minute. The MNQs are the micros. You've got the MNQ, the MYM, and the MES. They're fantastic contracts. If you're keen or interested in trading the indices and index future, these are wonderful places to start because the original contract size was very large. For example, on NQ, if you're trading NQ, a single point on that contract is worth $20. And as you can see, this moves around quite rapidly, this index. So that can be very positive or very negative very quickly and get to quite a large size in a short space of time, which is great if you're on the right side, not so great if you're on the wrong side. So the CME introduced these around about, I think it must be at least 5 years ago, because they wanted to attract more traders into the futures market, but give an instrument that was more representative at a retail trade level in terms of investment. So they've come out with these, and on the MNQ, each index point is now 1/10 the size, so it's $2. On the MYM, it's 50 cents. So you could start with that one if you wanted to start really small. As you can see, they are extremely fluid. And this is one of the huge attractions is that you get on some small contracts, particularly things like gold, for example, MGC, you might look at that and there'll be lots of gaps and spaces all over the place, which is horrible from a trading perspective. So you want fluidity, which is what you get with these contracts because they are now massively traded, very, very popular. And of course, they mirror what goes on the NQ, of course, but at a much smaller size. So it's $2 a point. So they're a wonderful place to start. Very quickly, I just wanted to show you a couple of things here. This is 7 o'clock our time in the morning, which is when Europe opens up. So the price action over here is for Far East, coming out of Far East Asia into the European Open. And what we get is a very nice example of how we look at price action over a group of candles rather than individual. We get underway with the first one. Looks we get obviously a massive increase in volume because we're moving into high volume sessions of both Europe and UK. So that's what we expect to see. But what you see here is a very nice little run up, not huge, but enough. And associated with that is the opposite of what we expect to see, which is, in other words, we've got rising price and we've got falling volume. And if that is the pattern of price and volume behavior, then you know for a fact that is not going to continue too far because what we need to see in any move is with rising price is rising volume. And in exactly the same way, when the market falls, we also want to see rising volume, which I know is perhaps more difficult to understand because we're all familiar with the concept of gravity. But that is a fact because if a market is going to fall, it needs the same amount of momentum energy as it does if a market is going to rise. So when you're looking at a market that's falling, you want to see rising volume. When you look at a market that's rising, you want to see rising volume. And in addition to that, what will also highlight the momentum in that move will be whether you've got widening spreads. So if you have a move where you've got a nice trend higher and the spreads are widening and associated with rising volume, very, very positive. Equally in downtrends, what we often see is what we call a price waterfall, where the spreads are widening quite dramatically, the volume's rising quite dramatically as well. That's got real momentum. And then we hit the bottom and we get stopping volume coming in. We see the buying coming in. We see the big operators and the market makers stepping in, bringing that move to a halt, buying, filling up the warehouse and taking it off and reversing it up to the next stage of the campaign. So I just wanted to highlight that because it's a really nice little example on the 5-minute. Now, the other thing I also wanted to show you here, a couple of other VPA examples plus volatility. This is the volatility candle. Now, you saw the example on the daily chart with what we christened the Trump candle, which was absolutely colossal. And the beauty of this indicator, it is not, I stress, it is not some wonderful miraculous device that we've created with hidden codes and it's going to give you everything that you want. What it does is it highlights volatility on the chart and it highlights it in real time. And it's important for several different reasons. First, and perhaps most importantly, it triggers before the candle closes. Now, on a 5-minute candle, that's important because it might trigger after 1 minute. So what is it telling you and how does it work? It's based on average true range. That's all it's doing. It's looking at the price candles of the previous X number of bars, and it is then calculating whether the price is in alignment with those or whether it's out of balance. In other words, it's an anomaly, in which case it triggers the volatility trigger, which you get these little purple magenta triangles top and bottom. The key to it is that volatility is almost always associated with insider manipulation, market makers, the big operators. And the reason it's so important is because volatility, the market makers understand that we are emotional traders and our fear of missing out is huge. So when we've been sat here for half an hour and nothing much has happened, and then suddenly the market snaps, as it did here, it snapped to the downside. This happened very quickly because it's the compression of time, as Anna said. The reason it does that is because the market makers want to entrap you into a weak position, and therefore they snap the market lower or snap the market higher because you will have a fear of missing out, you will jump in, and invariably what happens is one of two things. We either get sideways congestion or we get a full-blown reversal. In this case, we got both of which are painful. Sitting through congestion is painful, being taken out more so because you come out at a loss. And the reason it is so powerful is that because it is associated with the market makers, and you can see here we had very good volume under that candle, so they were certainly participating in that case. And what they wanted to do was crash the market down very quickly, although not huge in this case, it went 20 points, go into congestion, and then we see a nice example of buying coming in. This is where the buying came in under this candle, lots of volume, the market fell and recovered. There's only one way that that price could have been created in that way, and that is if the majority of volume under that candle is buying. Because if that were not the case, if this were all selling, the candle would have closed down here somewhere and probably deeper still, maybe down at this level, down at 300. It didn't. It started to fall and then it rallied again. And there's only one mechanism that could have created that in any way, shape, or form, and that is this has to be primarily buying, and therefore we can expect to see a rally in due course. Now, it may happen on the next candle. In this case, it happened several candles later, and we've now seen this nice trend develop. But that is what you are expecting. That is your initial signal. After you've seen this, you're expecting one of two things to happen, either congestion or reversal, and we got both. And equally to the upside, if you get a candle to the upside where the market suddenly snaps higher, you're expecting the same thing, only in reverse. You're expecting congestion and a reversal from high down, perhaps back into a bearish trend. We then move along, we start to break out, we get the first candle, that looks fine, volume and price in agreement, but then the second one comes along and we have complete anomaly. Why? Because if this candle is our benchmark, and there's no reason to suggest why it would not be, nice candle, no wicks, volume looks good, then the next candle comes along, what do we get? Double that volume, and only a marginal increase in spread. And even so, we get a wick to the upside as well. Just move my cursor out of the way. There we go. So clearly what we're expecting at that, once we see that candle, we're expecting one of two things, either a full-blown reversal from, I hesitate to call this a primary trend, but an uptrend into a downtrend, but certainly something is going to happen, because there's no way that this relationship is going to continue and roar on higher. And the reason for that is the reverse of what's happened here. So what's happened on this occasion is that we've had a lot of volume. In other words, what Wyckoff called effort and result. A lot of effort gone in, huge amount of effort, but the result is not in agreement, because if this is our benchmark candle, then given we've got twice the volume, this candle should be up here somewhere, and also not close with a wick. What the wick tells us is we've had some selling coming, and there's probably profit taking after we've had that little mini rally. Now, what then happens is we start to see the market reverse, which is what we expect, because if you see that, you're not expecting it to carry on higher quite happily. You're expecting something to happen, and that something is probably a pause point and possibly even a full-blown reversal. But what's interesting about this case is we get the first red candle, no great surprise. The second candle then comes along, but look at the spread. It is narrow and pretty much the same volume. And what that is telling you is that within this candle, that selling that was dominating this candle has now pretty much been absorbed, because if that were not the case, this wouldn't be a narrow spread. It would be a wider spread and mimic this one. And it's not, it's narrow. And this is a key part of VPA, because what that's telling you loud and clear, both from a spread perspective and from a volume perspective, is that don't panic just yet, because it looks as though this trend may well continue, which indeed it does. This would have been a little worrying, because we've got a market that's trying to rally and the volume's falling, although it's in agreement, this very narrow candle, low volume, which is what we expect. So volume and price are in agreement, but what we have here is a market that's trying to rally and the volume is falling. So we would be a little bit concerned at that point. This would be very encouraging. We saw the market dip and it's pushed up. That's great, good volume. And then we get another high volume bar. So we're expecting a little bit of a pause point, which is what we get. We get a pause, but again, narrow. And then we move on up to the next phase. And again, more volume gone into this one. Now, what's interesting about this candle is the spread on this candle is actually much lower than this one. We've got pretty similar volume. So what are we expecting? Well, we're expecting maybe a bit of a pause, maybe a bit of reversal. And now we're starting to see a bit of a reversal coming into effect there. So that's a little kind of VPA lesson just on that single chart, and also bringing in the importance of the candle. And as you can see, going back to, this is what we saw on the daily chart, this massive candle, and the volatility would have been triggered sometime during that period. So you don't have to wait till the end of the candle. And the importance of this volatility candle is this, that if you see it on a slower time frame, it will carry more weight than a faster time frame. So if you are trading intraday on a 5-minute chart or a 1-minute chart or a 2-minute chart, and you see one of these on a 15-minute chart or a 30-minute chart, be aware it is going to carry a great deal of weight in terms of significance of how the price action is going to unfold as a result. So there we go. That's the MNQ. Looks to be coming off a little bit now. Let's go on into Forex. So just picking up on that theme of the volatility candle, this was a real classic example. Again, similar, we've got 1, 2, 3, and then we've got 5, 10, and daily. And again, just the volatility candle here. This was a classic. This happens a lot. You'll see this a lot at session crossovers. And you can imagine the number of traders who would have been jumping into this candle. We've got a huge amount of price action in a very compressed space of time, very fast, lovely. Let's make some quick profits. What happens? It's reversed straight away. So the volatility indicator is absolutely key. We use it in all our coaching sessions where we are teaching our students based on volume price analysis and one indicator. And that one indicator that we all start with is the volatility indicator, because it is so fundamental to understanding why it is and how it is that the market makers are able to manipulate the market, and how we can combat that. Now, the simple rule that we employ with the volatility indicator is very straightforward. And it's like Anna said, the pebble, throwing a pebble into a pond or a large rock into the pond. So we get the volatility, we get a high and we get a low. And what we're waiting for is we're waiting for either of those to be taken out. So if we're taken out to the high side or the low side, we can then assume that whatever was the reason for that volatility, that we have now moved away from it. It's been absorbed, in other words. The ripples on the pond have calmed. We've gone back to regular price action, and we just sit and wait until, as I say, we move outside the range of that candle. It's very, very simple, very easy to use, and very straightforward. Just moving up onto the top line here on this workspace, I've actually got the VRSI as well. And you can see here how, we're getting underway. We've got this nice trend developing on the 1 minute. It's a very straightforward indicator. It's intuitive how you use it. And what it reveals, and the reason it works so nicely with volume is that it's looking at the same thing. We're looking at momentum here, because when you get a trend, you want to see energy. And that energy is reflected in the height of these bars and also in the color. Now, the taller the bar, the more energy is being input into that trend. And it's as simple as that. So it's really looking at, we've got rising energy going into the momentum in this trend. And equally, when that momentum is dwindling a little bit, the height of the bars will fall away, and we'll also get a color change back into these darker colors. And of course, as you would expect, once we get down to the fulcrum at 0 down here, we get the change in color. We go into exactly the same principles of a downtrend, bearish. Bright color represents momentum, and then we start to see that momentum dwindle, both in terms of height and also in terms of the change in color. And here we switch back above the fulcrum, if you like, into a strongly positive bullish trend higher, which is continuing nicely. Little bit of a fall away on the slower time frame here, but as always, we use multiple time frames in everything we do. So that's on euro dollar. Just going over, I'm sure many of you have seen these before, but this is the currency strength indicator, and really this is it cuts down a lot of time, because it will point you in the direction of where to look for great opportunities. Whether you are looking at it from the perspective of, well, I want to get into a situation where I'm seeing a reversal in sentiment, so I want to get into an overbought or oversold situation, or alternatively, where you're looking for something that is trending quite strongly. Now, what we're seeing at the moment, if you look at the euro, which is this sort of orangey line, and the dollar, which is the red line, the reason we've had that very strong trend develop is because this is the 1 minute. So we've seen a lot of buying of euro, a lot of selling of dollar. Equally over here on the 3 minute up here, we've got buying of euro, selling of dollar. And that selling is strong because the inclination of the line is very steep. And equally, the inclination of the line to the upside is very steep also. So if you add those two components together, we've got a euro which is being bought strongly and a dollar which is being sold strongly in this time frame. And we've got similar going on the 5 minute. We have the euro rising and we have the dollar falling. So it's a great place to identify, first of all, what is going on with individual currencies, which are being bought, which are being sold. Looking for opportunities where you can get into a reversal situation. In other words, if we looked at this 5 minute chart, we've got the euro, which is rising strongly here, and we've got the New Zealand dollar, which is very heavily oversold. Now, if the euro starts to reverse and the New Zealand dollar starts to rise, as it looks as though it is kicking up, it's kicking up on 3 and now starting to rise from the dead on 5. If the euro starts to roll over, that will be a situation where we are now have the opportunity of getting into an overbought or oversold situation. In other words, we are jumping on a trend early, which is great. But you have to accept that jumping on the trend and taking as much as you can out of the trend is going to come at a price. And that price is you have to set a wider stop loss. You have to set a wider stop loss to allow for the fact that the New Zealand dollar may oscillate around here. The euro may go higher still. It may oscillate before it actually falls. The one thing you can guarantee in the currency markets is this: it is a market of pure mean reversion. In other words, currencies, which is primarily why we developed this, primarily currencies oscillate from overbought to oversold to overbought to oversold constantly. They never go to zero, unlike stocks. And therefore, this is the ideal tool. It's like if you have any background in electrical engineering, it's like an oscilloscope. You get this sinusoidal wave up and down constantly, obviously at different levels, but that is the principle. If you want overbought and oversold, where you're getting in early, you've got to pay a price for that. The reward is you take all the profit from the trend. If a trend is underway, for example, if we looked at New Zealand dollar, I don't need to look at the chart on this time frame to tell you New Zealand is now rising strongly, dollar's still falling. So there will be a nice trend developing because the New Zealand is rising at a nice steep incline and the dollar's falling in the same way. So on a faster time frame, there will be a nice trend developing. Now you might want to jump on that trend, that's absolutely fine, but you're not getting in at the start here, you're getting in midpoint. And the downside is you take less profit, but the upside is you have to put less risk on the table because your stop loss can be that much tighter. And the other thing that the currency strength indicator will also tell you, it'll tell you which currencies not to bother with for the time being, because if they're moving in the same direction, there ain't going to be a trend there. So if you look at the pound and you look at the yen here, this magenta line, on this time frame, they're moving in the same direction. They're moving the same direction here. That will be in congestion. Don't even need to look at a chart. This is what I mean. You don't even need to look at the charts, but this is your starting point to identify. It's like a radar. It's your radar on the currency world. You can set these to any time frames you like. I've got them on 1, 3, and 5. It's very classical, but you could have them anything down, go out to the daily. If you're on slower time frames, have an hour, 4-hour daily, whatever you want. It'll give you that information, and it saves a lot of hunting around, and then you can go and choose and pick off those pairs that are giving you opportunities. This is the sister indicator. If you're trading cryptos, this works in exactly the same way. The only difference here is that all cryptos tend to move in the same direction, unlike currencies, which in a way is a good thing because it gives you a clear view on what is happening. And this is against Tether. This USDT is Tether. So effectively, that's really the counter currency, if you like, or the counter crypto, which is your the same as the dollar would be, for example. So this is effectively the dollar, this is Tether, and then you can identify exactly what is going on, but the principles are exactly the same. The only thing that changes, you can see here, they all move on. Sorry? Yeah, and you can also drop in others, as Anna's just reminded me. If you go into settings here, you can change whatever is on your TradingView platform. You can change, and you can select any one of these and just drop them in and create your own cryptocurrency strength indicator, which, as I say, is used in exactly the same way. Just very quickly, and then I'll wrap up. This is on the currency matrix, which gives you a view on what is going on in terms of euro. I've isolated out the euro. You can isolate anything, any of the currencies. I happen to filter on the euro here only because we were on the euro dollar earlier. And what you're looking for here is you're looking for what I call a full house. In other words, on the 5-minute time frame, which is what we were looking at over there, was you want to see all the euros sitting at the top here, because what that tells you is that the euro is then being bought universally across the currency matrix for that time horizon. We can see here at the top the euro dollar is the weakest, and we've got a nice stack here. Ideally, what we want to see is all these currencies moving up here. Now, why is it important? Well, it's important for the fact that if you're going to trade a currency, you want to be trading with the universal flow of that currency. So you want to be, if you're buying euro, you want to be assured that everyone else in the market is also buying euro across the complex. In other words, across all these other related pairs. What you don't want to see is a fractured market where perhaps you're trading euro dollar in isolation and buying euro when the rest of the market is actually selling euro. And really, that's why we developed this indicator. This is much more of a scalping tool. It has a relatively short look back period, but it'll give you that information in real time. And again, you can set I've got these at 1, 3, and 5, but you can have these on any time frame you care to choose. I'm going to stop there, and I'm going to pass back to Anna. Yep, is that okay? Yep. I think we've are we caught up with the questions? Yep. Okay, fantastic. Before I do that, very quickly, sorry, just to touch on another indicator. This is the currency array, and um, the reason I mention it is because what the array does is it has a much slower look back. It's looking at trends over a longer period, and therefore it's more applicable to you if you are a swing or trend trader. The principles are the same as on the matrix, where first of all we can isolate out into a currency of choice, and here I've got the pound. So we can see what is going on, and we get a visual on the strength of trend, either up or down, in this very visual way. It's almost like a radar. So when these are all moving together, they all swing up or they'll swing down, depending on which is the counter currency. And the second thing about it, as I say, it has a much slower look back period, so it will be a much slower pace. So you'd use this for your swing trading, whereas the matrix you would use for your intraday fast scalping. And the other column on here, again, this is like a little bit like the currency strength indicator. What this OB means, it's giving you a heads up on that currency pair which may be approaching or at an overbought state. If it's in brackets like it is here, then it's approaching a potentially overbought state. As here, and where it goes to bright blue and with brackets removed, it's at an overbought state. And you can go and have a look at that one and say, okay, yeah, fine, that looks a little bit oversold. Let's see what we can do. You look at volume, look at CSI, etc., etc., and then you decide. So again, this is like a radar. This is a radar on currency pairs over a much slower time frame, but it also gives you a heads up on opportunities that may be developing. For example, you're a CAD now looking as though it may be getting to an overbought situation, but we have to wait until it goes bright blue, and then off we go and look at the chart. So that's like a suite of indicators to help you. There is another, which is the heat map, which I don't have up at the moment, but the currency heat map is another in that suite of 4 indicators, which are contained within the currency dashboard, which are across all the platforms. So I'm going to stop there, and I'm going to pass back to Anna, if I can find my mute.
I said at the beginning we were going to do a little bit more on Forex, but I think actually we've gone much longer than we anticipated on the volatility. But it's just so important, especially at the moment, that I think what we'll do is we will set up another live stream, and we will dedicate that to the Forex traders out there. However, all I would say is, other than the specialist Forex indicators that we've developed, the strength indicator, the array, the matrix, all the other indicators you can apply to whatever you're trading, whether it's a commodity, whether it's a stock, or whether it is a future. And if you want any more information on the indicators, if you head over to quantumtrading.com, there are loads of videos on there. And if you want more sort of detailed information, then just drop Jonathan an email at helpdesk@quantumtrading.com, which I've actually put on the in the chat. If you've for those of you who've come along or have watched this live stream, you do get a little bit of extra discount. There's a code which you can apply, which is, what's that one? LS20. Yeah, you get an extra 20%.
Send an email.
Yeah, if you send the email to helpdesk@quantumtrading.com, we will give you the code, and there'll be an extra 20% off the and also on our education programs, which are both for stock and for Forex. I mean, they're all very competitively priced anyway, but you get a little bit of extra for taking the time out of your day to join us. So all I have to say is thank you so much for coming along. I know I keep saying this, but we will be doing this much more, trying to do them more regularly. Someone actually asked in the chat, well, do you actually trade? Yes, and that's primarily because that's probably why we don't have a lot of spare time for these sorts of events. But we will we will do our very, very best to share our knowledge and expertise of VPA and the markets. But as you can appreciate, trading is a very intense experience, as it were, and especially with the markets now, as I said, they are poised at this inflection point. It is going to be very, very interesting going into the this last quarter, which has always been the most lively. Are we going to get a Santa's rally? What is the Fed going to do? What is Trump going to do? And how is that going to be reflected in the charts? But if you understand, certainly VPA, you understand volatility, you understand how volume works, I think it will give you not just that additional edge, if you like, but at least it takes away. What does people say to me? Well, what will VPA do for me? And I think what it does is it just takes away that emotional stress that we can all suffer from when you have an open position and when you have money in the market, because you read the charts as David did earlier. And please go back and, if you've got time to go back and listen to what he said and how he analyzed that chart. It just gives you an insight into the probability of what it is going to happen. And the great thing about VPA is these signals, these setups, these anomalies, they happen time and time and time again. And once you start to recognize them, that is what will give you the confidence. And with confidence will come consistency. So have an absolutely fantastic day. As I said, it's going to be a key day today and obviously moving forward as well. And we will be back with you very, very soon. Take care, everyone. And after today, have a great weekend.